Welcome to our CFP exam prep discussion focused on original issue discount, specifically how bonds issued below par must accrete the discount annually for tax purposes. This is a critical concept that frequently appears on the exam and often trips up test takers. Let's break down original issue discount, or OID. When a bond is issued at a price below its par value, the difference between the issue price and par value is called the original issue discount. For example, if a bond with a $1,000 par value is issued at $900, the OID would be $100. The tax treatment of OID is what makes this concept particularly important. The IRS requires bondholders to report a portion of the discount as interest income each year, even though they haven't actually received any cash payments. This phantom income is considered earned annually through accretion. Here's how it works in practice. If you have a 5-year bond with a $100 OID, you can't simply wait until maturity to report the entire $100 gain. Instead, you must calculate and report the annual accretion of the discount using a constant yield method. This means the amount of OID you report each year will actually increase over time due to the compounding effect. A common mistake students make on the exam is confusing OID with market discount. Market discount occurs when you buy a bond in the secondary market at a price below par. While similar in concept, market discount has different tax treatment. Unlike OID, market discount generally doesn't need to be reported annually unless the bondholder elects to do so. Another frequent error is failing to recognize that certain OID bonds are exempt from this annual taxation rule. For example, U.S. savings bonds and short-term obligations with maturities of 1 year or less have special treatment. The exam loves to test these exceptions, so be sure to memorize them. The calculation of OID can also be a stumbling block. The exam might present you with a scenario where you need to identify the annual accretion amount. Remember that the accretion isn't simply the total discount divided by the number of years. It follows a compound interest pattern, meaning the annual amount increases each year. Let me share a tip that has helped many successful candidates. Think of OID accretion like a snowball rolling downhill. Each year, the snowball gets bigger, not just by adding new snow, but also because its larger size helps it collect more snow. Similarly, the annual OID accretion grows larger each year due to compounding. When you see an OID question on the exam, first identify whether it's truly an OID situation by checking if the discount occurred at original issuance, then determine if any exceptions apply. Finally, if calculating the taxable amount, remember it must be done annually and will increase each year. Most importantly, understand that this tax treatment reflects the IRS's position that economic benefit accrues to the bondholder each year as the bond approaches par value, regardless of whether any cash changes hands. This fundamental principle will help you answer even the trickiest OID questions correctly. Remember, the CFP exam tests this concept because it's crucial for real-world financial planning. Your clients need to understand the tax implications of purchasing OID bonds, and you need to be able to explain why they're receiving tax forms showing income they haven't actually received in cash.